Good morning, everybody. Aren't we so glad that we're home and warm and safe today? I am so pleased you could all be here. We've got a great crowd to discuss the great crash, and welcome. Linda Walbert is one of our HASP stars because she's a member, and she presents practically every semester. She and I have known each other for a while now, and she's not only a presenter, she's a published author. She has published books about Frederick Douglass, and we've talked about that. And she's published children's books as well, which I think is absolutely fascinating. So she knows what happened at Hope in 1929, although I guess not firsthand. But she is a graduate of Hope College. She went on from there to get her master's at the University of Chicago and her doctorate at the University of Chicago. In 2014, she did retire from teaching at the University of Cincinnati Claremont College. And I know this is just going to be so interesting, especially if some of you saw George's comment in the chat about how just recently we've had some lessons in the ups and downs of the stock market. So thanks all for coming, and I'm going to turn it over to Linda for what I know will be a very interesting presentation. Thanks, Linda.
Thank you, Diana. Jeremy, I don't think I need this on my screen. I can just stay here.
Okay.
If you don't mind, I won't switch to my screen. I'll just leave it on the, okay, I think I know what I'm doing. Yeah, just click here. Okay. I want to welcome you all. I really am happy that we have a good group this morning who are going to bring lots of interesting questions and knowledge to the table. And I think we should plunge right in. Remember that my PhD is not in economics or stock predicting. And if we read John Kenneth Galbraith, an academic background isn't all that much guarantee that somebody knows what they're talking about anyway. He's frequently criticizing some of the professors. But I think that this book, and I hope you feel the same, is written in a way that doesn't use jargon, doesn't go way over our heads, and tells a story in a way that we can latch on to some kind of new information and insight into what really happened in 1929 and why and what it might mean for today. Today, we're surrounded by ads for gambling every single day. Aren't we all just stunned with how much TV time is spent advertising casinos and trying to tell the young people all the different ways they can get into the market? And now that sports betting has been curbed for next Sunday somewhat because people can't be there, maybe people need a new way to make a bet. But those of us who have looked more clearly at the stock market, or probably most of us directly or indirectly are invested in the stock market, we have a better understanding how important the stock market is to American business and the American economy, as Galbraith does in the end make clear in his book while he is showing some of the reasons of why things can go wrong. We're also meeting every day these last few weeks stories about GameStop, where the amateurs are getting into this stock and running it up and what's going to happen and who's going to win and who's going to lose. And so we're all reminded of that old adage we probably learned as children, which goes, well, maybe not as children, but maybe in college, a fool and his money are soon parted. That comes from Poor Richard's Almanac, way back in Benjamin Franklin's day. A fool and his money are soon parted. And some people think that the stock market is just another form of gambling. And you can get lucky because maybe what you gambled in was a good company. And so you did make some money, but on the bottom line, it's only gambling. At the end of chapter 1, John Kenneth Galbraith introduces a quote from 1929, where someone said, notably said, Well, when you invest in the stock market, everybody wins. Whereas when you gamble, somebody wins and somebody loses. And I trust that we understood that Galbraith is pointing out that that statement is profoundly wrong, that in the stock market, all people win, everybody wins. So we'll take a deeper look with Galbraith as we start going through this. Now, when I was young, I had no knowledge really of the stock market was, what the stock market was. I think that people in my age group and demographic really didn't learn much about the stock market until we were starting to have retirement funds or some kind of 401k or something that would involve investment, and we wanted to know something about what was happening to our money. Galbraith's book is going to did enrich my financial intelligence. And so it seems to me that Galbraith is outlining what is good about the market and also identifying what are the pitfalls and things that cause things to go wrong. I think we learn our ideas about human nature. Galbraith has a real respect for human nature. One of the things he says in chapter 1 is that the common wisdom about the crash is going to point to technical things that changed, that caused the market to start tumbling. Like the fact that Winston Churchill went to the gold standard in 1925. And so the Brits came over to the United States and said, we need easy money. We need you to lower the rate on how money can be borrowed. So the Secretary of the Treasury said, okay, we'll lower the discount rate from 4 to 3.5%. And therefore, Galbraith says, everybody says that's why the market tumbled. But Galbraith is going to say, nonsense, there's more to it than something like that. It's not a simple thing. And Galbraith is going to go back to psychology. And he's interested in what is it about human nature? The stock market is a human invention. What is it about human nature that's going to take the fact that, yes, there are, quote, fools out there, people who don't know what they're doing. They jumped in without studying what they're doing. They think that they're just gambling on something. And then there are people who have more financial intelligence and know what to do. As we go through the chapters, we'll touch on what Galbraith thinks about what do you do about all the fools in the market? Is it the public's responsibility to rescue every fool? I don't know. That's a profound question. Galbraith, I think, says you issue warnings to those who don't know what they're doing. You make sure that you repeat the warnings. But once people have been warned about the risk, then they have to take their chances because you don't have a real market. If then over on the side, you have this slush fund from which you're going to help out everybody who loses something, then you don't really have a true market and you're not, quote, properly rewarding those who did know what they were doing. A fool and his money are soon parted. There's an old joke about two hunters going out into the woods and all of a sudden they're facing an angry bear. And the one hunter says to the other hunter, got to put our shoes on, we're going to make a run for it. And the other hunter says, can we really outrun a bear? And the first hunter says, I don't have to outrun the bear, I only have to outrun you. So that brings out this theory that not only a fool and his money are soon parted, but the greater fool theory about why somebody might buy something that they know is relatively worthless, but they also know somebody's willing to pay more for it. And that's what's going on in GameStop right now. How many of you have, wave your hand if you've heard a little bit or read a little bit about the GameStop phenomenon that's going on right now of amateurs in the market trying to outwit the hedge funds. And this is a game, most people agree who are commentators, that GameStop itself is not worth anywhere near the 340 or whatever it is today. when about a month ago it was $17. And that people are speculating in this. And sooner or later, they're going to run out of buyers. They're going to run out of the greater fools. And then we'll see who are the fools who really end up with something at the end of the GameStop scenario. Yes, some people will make money, but that's sort of based on the greater fool theory, where if you studied the GameStop business, you would not even begin with it. Let's start with chapter 1. I think the interesting thing about this book is that we have here two John Kenneth Galbraiths. We have John Kenneth Galbraith and his son, James Kenneth Galbraith. And we're looking at the work of both of them because both of them are noted economists. Now, John Kenneth Galbraith was born in 1908. That's interesting because that means that in 1929, he was 21, just coming into adulthood when he could begin to know what's going on. And so he wrote the book about the crash of 1929 in 1955. And in 1955, Congress was in the process of trying to figure out whether the market had climbed back to the levels of 1928. And therefore, were we in danger again of another crash? And so Congress becomes very concerned and calls in all these economists, like Galbraith would be one of them, to testify about whether they thought in the 1950s that the markets at that time were overpriced and were headed for a fall. Now, if I asked you before you read this book, how long did it take for the stock market to get back to the level that it had in 1928, the numbers that it had, or the price that it had in 1928? Well, I asked several people in my family, how long do you think it took? Well, not through the Depression, but then they would guess maybe 1938, 1940, 1942. It was 1951 before the stock market again hit the level it had been at in 1928. It was a very long time. And so when it did then in 1951 hit that level again, that triggers Congress's worry, or the nation's worry, that maybe we're headed, maybe we're overheated again, maybe the bubble's going to burst and we'll have another disaster. And in general, the economists reassured Congress that although there were things that needed to be fixed about the way the system worked, nevertheless, the values of the overall economy, the gross domestic product, the industrial production and everything, had justified the prices where it was in the 50s. But then you still had a long period of time when people were spooked about the idea of the market. And I'd like to see a show of hands. How many of you had parents who would invest in the stock market as just part of their logical or proper handling of money? How many of you had parents who would not invest in the stock market? They felt a depression attitude that was a good way to take a fall. And you wouldn't do that. Maybe you would invest in buying a house that you would rent out, or doing something you understood, but not getting into the stock market. And so one of the interpretations here is that for a very long time, maybe until the late 50s or even the 60s, confidence in the stock market didn't return even when it should have, even when the values were there that did justify those investments. Now, we mentioned that Galbraith was born in 1908, so he's 21 in 1929. I want to mention another birth of somebody. Warren Buffett was born in 1930. He was born in August of 1930. And his father was sold stock to people out in Omaha. So Warren Buffett's father had been selling stock to people he knew, people right in the community through the 20s. And then here comes the crash. And Warren Buffett told the story in one of his annual meetings. His father is just sheltering in place when the crash comes. He just doesn't even want to go out in the streets because he keeps meeting people who lost money and he sold them those stocks. He's just so freaked out. And so his father, he said, is staying home so much that that's why he was born in August of 1930. And so he's born into an atmosphere of all that fear. His father eventually went to Congress, was elected in his area. So I guess people restored their confidence in Buffett himself. And Warren Buffett's father was a congressman. Warren Buffett today is considered one of the most successful investors in the history of American, life, and also has a very sterling reputation. So Warren Buffett, in his annual meeting last year on May 2nd, 2020, told his shareholders, I have 2 books to recommend, and one was a biography of Paul Volcker, which is very heavy. But the other one was this book. He said, it's a wonderful book. You'll enjoy reading it and it will teach you a lot. So I thought, well, that's a good clue. I'm going to look it up. And I knew the name John Kenneth Galbraith. So after looking it up, I decided it would make a terrific book to use for HASP. I also want to mention one other book that Buffett has frequently recommended that is an introduction for investors to the concepts of investing that count. And that is a book called The Intelligent Investor by Benjamin Graham. And Benjamin Graham was a investor, an economist of the early days. Benjamin Graham's book, The Intelligent Investor, is encouragement that the average person, just by being diligent and studying, can successfully invest. And Benjamin Graham's book describes Mr. Market as if Mr. Market is a person. And he describes Mr. Market as, in the short term, a crazy, drunken psychotic. But in the long term, Mr. Market gets the right answer. So the market is, in short term, nuts. And it's because the market is nuts about certain things at a certain point that creates your opportunity to buy an undervalued security. So his 3 suggestions, his 3 rules for the investor are: number 1, plan for the long term. Analyze for the long term. Analyze what you're doing for the long term. 2nd, protect yourself from losses. And 3rd, don't go for crazy profits. Well, those seem like common sense things, but how many people get into the stock market and forget 1, 2, or 3 of those rules? Warren Buffett is famous for saying that he has 2 rules for investing. Number 1 is don't lose money. And number 2 is don't forget number 1. Now, Warren Buffett is full of aphorisms, and his letters to shareholders, his annual letters to shareholders, which are public domain, you can find them online, are just an amazingly well-written and fantastic year by year discussion, not only of his own businesses, but of the ideas behind investing and of what's going on in the investing world. I want to go through now a PowerPoint that I prepared, and I will see if I can get that up on the screen. Now, let's see. This is supposed to pop up on the screen, Susan.
It's actually, we're seeing it, Linda, on our side.
Okay. All right, so it's just not on my screen. Okay.
Is it on the wall, the projection screen?
No, it's not on the projection screen. But that's all right. I'll just work off of, I have it on my laptop. So as long as you can see it, we're good.
We can, thank you.
Okay, so.
We see it.
All right, so the basic book that we're reading, the 10 chapters, are written by John Kenneth Galbraith in 1955 as he looks back on 1929. Then, as you see on the credits page, this book was republished again and again and again. So in 1988, it was published again with new insight from Galbraith. And then one of the introductions is by his son, James Kenneth Galbraith, looking at the book. And both of those introductions, I think, Diana, you were saying you thought one of those introductions was so interesting because it was comparing the crash of 29 with the crash of 2008. So as you look at these different parts, don't miss those two introductions because they do give you a good preview of the book. Now let's see.
There, we've got it, Linda.
All right, now, both the British and the Dutch nations formed East India companies and West India companies in order to facilitate investors in those countries raising funds and pooling their funds in order to fund various ventures abroad. And so here is a little clue that a stock exchange was established by the East India Company in the 1700s and was 22 stockbrokers opposite a town hall created buying and selling transactions in shares of companies. Here's Amsterdam market in probably the 1700s. So we needn't think that the market for futures prices of shares in companies is anything new. It does go way back, and the Dutch had a heavy hand in it. You can see from the architecture that just the building gives you idea that everything is stable, these arches and these kind of almost Gothic looking structures here give a sense of grandeur and stability and like Rock of Gibraltar and the whole concept of stability. If you think of the way most banks look, most banks are located in a building that looks like a big stone, sturdy structure. Here's a shot of people on the curb establishing trades in early New York City. And the idea is that buyers and sellers are making negotiations, establishing a price. So price discovery is one function of an exchange. The price is established or discovered and recorded. The whole system of recording transactions is essential to any kind of market that's going to support a capitalist system. If you can take your trade back or say, no, I didn't say that, or that's not what I meant, you have to have a contract-based culture to be able to create a stock market. Everything got bigger, one thing led to another. There would be more money, more traders, more stocks to exchange, and more money borrowed, and capitalism is at work to facilitate the ventures that people were designing in order to try to go in business and see if they could make a profit after all was said and done. Look at the architecture here again, lots of light, soaring columns. It seems to say the sky's the limit and the money is safe. And so people trust. So the trust of the people in the system is essential to the function of this market and the willingness of buyers and sellers to feel that the brokers and the clearinghouses and the government or money supply behind it are all sturdy and safe. Obviously, back in 1929, the ticker tape came from something that was much bigger than one of those clocks that had a glass dome over it, but it was a ticker that had a glass dome over it, and it would actually tick, tracking by telegraph signals the current prices. And of course, today we have this extremely sophisticated price ticker visible in many, many places across the country where people can follow day by day and now moment by moment the changes in prices of stocks on the stock market. Then from that stock market that was actual buyers and sellers making their deals, there developed a whole set of special kinds of buys and sells. One kind of sell would be a complete liquidation. Somebody went bust. It's interesting that our rules about bankruptcy, which are intended to give someone a fresh start, to wipe out all the debts, pay the creditors what they can get, and then that's the end of the story. That's a bankruptcy or foreclosure. In a way, gave mercy to the debtor. The debtor could get out of his debts. He might have nothing at the end or certain exclusions and exceptions where he could still save enough to survive, but it was liquidated. That goes back to the 1600s. Beginning in Dutch law in the 1600s, bankruptcy law was already established to benefit belly up corporations and let the investors get their money back out and let the person who owned the company not suffer a complete and total lifelong disaster. The phrase good as gold indicates that gold, at one time, the currency was backed by gold. At one time, the United States thought that they could hold enough gold to back all of their currency. By 1896, it was obvious that they couldn't possibly do that in actual dollars, but the United States still does hold gold reserves as a kind of symbol of backing the currency. A stock option came into place. You don't actually buy it, but you, for a very small amount of money, you buy an option to buy it. And maybe you never exercise your option. Well, then your 20 bucks or your 50 bucks was lost, but you decided not to go ahead and buy the stock that you were looking at. And that was a kind of future prediction. So in a way, the whole stock market, when people get in, is trying to play for the future, is trying to make a future prediction. But then buy-sell agreements can result in certain kinds of futures markets where there is actual contracts on futures prices. But that's a separate area. The Chicago Board of Trade, how many of you have heard of the Chicago Board of Trade? It's mentioned only once in Galbraith's thing, and the Chicago Board of Trade arose around commodities: wheat, soybeans, corn, pork bellies, etc. And you would trade in all those things, where farmers with those things to sell wanted to lock in the price at which they would sell them. So a speculator would come along and promise the farmer, I'll pay you such and such for your corn next year. And in that way, the farmer could reduce his risk and the speculator could take it on. That type of thing. But and there were cotton exchanges in the South that did the same thing. Traded a commodity where the actual commodity was going to be delivered against a future prediction. That's a separate area. Then there are always auctions of real estate to liquidate it. And throughout the history of the world, auctions of assets like liquidated, and auctions for cotton, cattle, and slaves. In chapter 3, in Goldman Sachs We Trust, Galbraith is going to describe the investment trusts that rose up in 1929-30. And this is an example of a certificate that certainly looks like it's money. Look at the border and look at the number 100 there, 100 shares. So this is a certificate for 100 shares of the Massachusetts Investors Trust. And again, look at the kind of symbolic, the symmetry, the detailed lithography, the like as if you can't possibly counterfeit this thing, and the stamps on it to show that it's been transacted. So today we no longer gather up and keep all these certificates of what we own. It's all online. But the investment trust will come into play in our discussion.
Linda, can I ask a question?
Yes.
What is the difference between the investor's trust and a mutual fund?
I believe a mutual fund is a kind of investor's trust. It's an offshoot. It's a type of trust. But the mutual fund today has extremely detailed requirements of revealing to the customer, what do you own, what stocks are in there, which funds are you investing in within the mutual fund. They have to make disclosure. Whereas in the era that Galbraith is talking about, it was a big deal that it was a secret. Oh, these very wise men, they couldn't possibly tell you what they're investing in because somebody else would want a piece of it. And so it's all a secret. And so you don't really know who's really behind it or what they're actually investing in. So the mutual fund has lots of guarantees behind it of how it works. But the investor trusts that grows up in the 1930s were just hot air. They were just like much more of just a game that was being played to trade off of people's trust in a name like Massachusetts Investors. It sounds important. Here is October 29, 1929, and people are rushing in the street. What are they trying to do? Well, they might be trying to take money out of their bank to cover a margin call. But the bank is closed. The bank is closed. Bank closures, including right here in Holland, the state bank, People's State or whatever it was, closed. So neither you nor your church nor your organization could draw their own money out of the bank. The bank was closed. They didn't have the money. So the closure of banks was one of the things that happened in the 30s that Galbraith is pointing out can't happen today because of the federal rules that guarantee that. And here is another shot of people in the streets. But it's not necessarily that these crowds are also people waiting to get their own money out. They just could be a crowd that's excited about something. They've heard that the stock market is crashing and they're getting out into the street just to kind of be around the stock exchange and try to learn what's going to happen next, and how the mighty are fallen. There's another shot of the crowds in 1929. There's a story that when John D. Rockefeller was getting his shoes shined one morning, his shoe shine person said that he was buying a certain stock. And that was the point where Rockefeller said, boy, if my shoe shine man is buying this stock, I better get out. That was his clue to get out, because the raggedy multitudes were buying this thing now and Rockefeller would sell. That's kind of an apocryphal story. But one thing we're watching as we read this book is, what about the idea that everybody should get rich? Do we have an idea in America that somehow the ordinary person trying to save for retirement needs to do so in some measure by participating in the stock market with help and with the correct principles, but that everybody needs the stock market? I mentioned that both of my parents started at Hope College in the fall of 1930. They had a classmate whose father had given him all of his tuition money on the way to school. So he gets here on September 1 and he's got the money in his pocket or in a cash bank account or something. And he decides, well, he goes to the treasurer's office and finds out that the tuition isn't really due till November 1. That's the last date that you can pay it without a penalty. Says to himself, in that 2 months, I can make some money. I'll put it in the stock market. And then when I pull it out just before November 1, I'll have a lot of spending money for my year at Hope. And of course, when he goes to pull it out, it's gone, because that's when all these crashes. So he has to go home and tell his father that he lost his Hope College tuition, putting it in the market. What would you do if that were your son? Would you make up the money if you could? Would you make him stay home and not go to school? Would you be furious with him because he disobeyed his parent? Or what would you do? It happened. In 1929, the newest building on campus was Dimnent Chapel. It had just been finished. And think of this magnificent, symmetrical, beautiful building and its glorious interior with the high Gothic arches and everything. Such a beautiful place for worship, and such a symbol that there was confidence that Hope College was a substantial college that was going to be here, and here was the testament of the faith. The college owed $11,000 on this building when the market crashed. So that was one of their problems they had to work out of in 1930. And Hope College had had severe restrictions on what the college was allowed to invest in. So they only could own a certain type of real estate security that could be owned by banks. I mean, some very arcane thing, which also had gone to nothing. So the president's memoirs show that the college did take the hit, sell for practically nothing what they had, and change the rules and buy some stocks, which did then recover over the next 5 or 10 years so that Hope College didn't have to close. Later on, we will look later in the class. We're going to share some stories about how the depression, how the crash of the market and the depression affected our families and what we remember, or what we knew growing up about this, because our generation maybe has memory of several times when there were significant downturns in the market. For example, 1987 was a very drastic year of a crash in the market. And again, 2008, how many of you remember 2008 and the housing crisis and everything that happened in the country as a result of that, and probably knew people or saw things in our towns and villages and families that reflected that very disastrous drop in the market. Are there any questions? Okay, now.
Let me, Linda, if I could just say to the group that discussions move along swiftly. If you have a question or if you have a comment, please don't bother to raise your hand and be recognized. Just unmute yourself and just ask, or just make the comment. And of course, you can always avail yourself of the chat box too. But either is acceptable when we're talking about book.
So let me take a minute now then to take any questions that you have about this, about what did Galbraith bring to you that was new and interesting that you hadn't understood before, or that put a question in your mind.
I think it brought relevance. I mean, all of a sudden you could identify in part because of some of the things that are happening now, some of them political, not just financial, but how relevant something that happened this almost 90 years ago, how relevant it is. You just exchange some of the players and some of the same issues. So it brought back a sense of relevance that you don't often think about.
Exactly, very striking. For example, our new Secretary of the Treasury, Janet Yellen, the very first woman to ever hold that role, met with the Federal Reserve the other day in order to discuss volatility in the market. So right now, as we speak, as you say, Ben, you know, the Secretary of the Treasury is going in to say, well, do we need to put some government restraints on this somehow so that this doesn't get any more crazy than it already is? Because we can have a bubble here where the GameStop people are going to learn their lesson or maybe make a few bucks, but we don't want it to have a domino effect and start wrecking the larger market and just causing some drastic result that we didn't even anticipate. What might they be discussing from what you've read so far? What might she be thinking of having the Federal Reserve do?
Well, whether you're looking at rates, any adjustment on rates,
yep,
or terms, I think they're all is just a matter of, part of it is the willingness to acknowledge and respect some of the early warning signals rather than ignore them because of what you have at stake.
Okay, good point. So that implies that Janet Yellen at least thinks there are early warning signals, or at least she wants to know what's going on. She wants to. So when she's speaking with the Federal Reserve now, the Federal Reserve is under the Treasury Department, and the Federal Reserve is a set of 12 banks all across the country, the most important of which being of New York City, the Federal Reserve of New York City. And they control the rates, meaning the discount rate, the rate that banks have to pay when they borrow money from the Federal Reserve. So can they change the rates? Yes, they can, can't they? Ben is implying that rate can be changed under the authority of the Federal Reserve. It's not up to the banks. Now the banks set the rate at which they offer loans to people. But what would be the connection of the Federal Reserve to GameStop? When people invest in GameStop, they would either be cash investors. They are investing their own money. They're the teacher in Holland, Michigan, who has $300 in a savings account and decides to put it in GameStop to see if he can turn it into $900 in a short period of time. See if he can do that. He's willing to risk the 300 to see if he can get the 900. Is that legal? Sure, it's his own money. Is it safe? Probably not. Is it a gamble? What are his chances of winning on that? Well, as long as new people who want to get into GameStop, who get into the game, as long as more people are flooding into the market, the price is probably going to go up. And as soon as you reach the maximum people that want that, and there's nobody new, the price stops going up, and now it's going to go down. Go ahead, Barb.
I'm interested in how much of this stuff is being purchased on margin and what the current margin rate is. I don't remember exactly when the old rule after the big crash, the margin rate until at least after World War II was set at 90%. So that you didn't get a run on the banks. But I don't know what it is now.
Okay, good point. And anybody else want to contribute a thought on that? I think Barb has put her finger on one of the key things that Galbraith is talking about all through the book.
The last time I checked, the margin was 50% in the US. I don't really buy stocks on margin, so I don't know, but I believe it's still 50%.
Okay.
And the interest rate is right now, well, interest is like dirt. It's nothing. So it's probably in the 3 or 4% range on margin. The interest rate on margin is higher than the interest rate on buying raw land or buying a house. It's more equivalent to just getting a line of credit. And the last time I got a line of credit, it was higher, but I think right now the line of credit line is in the 3 or 4% range.
Okay.
The thing is that the typical marginal is not going to let you go 50% on your entire account if you have a account of a few $100,000. They're not going to give you let you go half. What they'll go half on some stocks, but they probably will give you a cap, and so you can't borrow 50% of the whole schmeal. That's the way it was a few years ago. I don't really exactly know what it is today.
Okay, thank you, George. And as you indicated, the federal government, I believe, now remember, anyone can correct me at any time. I'm not afraid of being wrong. You're not going to hurt my feelings at all. But I believe that it's up to the banks to decide how much risk they want to take with a certain investor. Like if they think that George Borchter is good as gold, they're going to let him borrow more on margin than somebody who just started investing yesterday and hasn't proven anything, doesn't have this established account or something. It could vary with the investor. Do you think, George, or do you think it has to be at any given time equal treatment of everybody within a certain institution? I don't know the answer to that. I know that you can sometimes have to have an initial margin. So if you want to come into the bank and you'd like to have 80,000 invested, but you only have 40,000 of your own, they might let you do that depending on a lot of things. And then the maintenance margin might be 25% or 40%, 50% when you come in, but then 40% ongoing, because your margin loan can vary day by day as you buy and sell things. But there are many, Warren Buffett's rule of thumb for the individual investor is don't borrow money at all for stocks you're going to buy. Don't borrow, it should be your own money, not borrowed money. How many of you agree with that? 100% your own money. How many of you agree? How many of you in your experience do agree with some margin borrowing within limits? You would do some. but with, extreme limits on what is it you're borrowing money to buy? How safe is it? How sure are you? Okay, so we have George would do some margin buying with severe limits on yourself that you've thought through.
That's within this whole thing of regulation, though. With the deregulations that has occurred over the last 50 years, I would be scared to do too much of it.
Because of what can happen, how quickly 50% is no longer enough. I mean, and
Exactly.
as how quickly 50% is no longer enough. It doesn't take a very big market drop overall to put you into territory where you have to put up some more money. And then if you don't, a margin call is a call. It means you owe it right now. If you get a margin call, you owe it immediately or like within 24 or 48 hours.
I don't think it would be a very prudent policy if you had a 50% margin to be in deeper than 20-25%, because then you can sustain a 15 to 20% drop and you won't get an actual margin call for dollars. It's the same with it's the same with deciding you're going to buy 3 houses as a real estate investment. You better have coverage on the ability to make the payments, so that if you have one of the 3 renters move out, you don't get all 3 foreclosed.
That's right. You don't get all 3 foreclosed, right? Because of the domino effect. If you're leveraged so that the equity in one is used to pay for the next one, and then the equity in that is used to pay for the next one, you've got mortgages on all 3, you very easily could have something fairly small happen that topples all 3. That's what you're describing, isn't it, George?
Yeah.
Yeah.
Excuse me, wouldn't it be more precise to say that we're talking about borrowing money from the brokerage house or your brokerage company? You don't really go to the bank to borrow money to buy stocks on margin. You borrow the money from your broker.
Correct. That's correct. So in other words, Brad, the broker should, in a way, the broker should have the right to tell you what your interest rate, not have it dictated by the Federal Reserve.
Correct.
Yeah. So it's depending on what brokerage house, how much risk your brokerage house is willing to accept in both.
Well, my understanding is I would assume that rates are competitive from one broker to another.
Yeah.
Within your brokerage account, as someone, I think it was George said earlier, they value your portfolio differently as far as how much margin they will extend to you.
Depending on the quality of your portfolio.
Yeah,
Yeah.
for sure. If you're holding a bunch of grade A stuff and you're going to get a higher percentage of margin available to you, as opposed to you own a lot of speculative stocks.
Okay. So Brad, let's say that you had an investment portfolio and you had some really tried and true, like really good stuff in there. Like you've got some Procter & Gamble and Johnson & Johnson. And then you decided to do a little trip in GameStop at the same time. GameStop is up. Now, GameStop goes through this big thing and you get a margin call. What are your choices? Are you going to have time to say, well, let's see, shall I just let them sell out the GameStop, or shall I sell some Procter & Gamble in order to cover my GameStop problem?
Oh, you have time to determine that. You get the call and you decide how you want to handle the account.
How much time? An hour, 2 hours, 2 days?
I think in practical terms, probably a day or 2, but
Yeah.
things would move quickly in that time.
Yeah.
Even in today's world, you get a notification and you've got to clear it up.
So then, as one of the commentators about GameStop said in an article the other day, the investor ends up having to sell their winners to cover their losers.
Yes, that happens, sure.
Yeah. Or if you decided, okay, broker, go ahead and close me out on the GameStop. You sell it. They will sell it. If you don't take care of the margin call, they will sell the security.
Sure.
But they decide to sell your Procter & Gamble and let you keep the GameStop.
Well, hopefully you'd have a conversation with your broker and you might very well put money into your brokerage account, to let that position continue.
That's right. That's right. You can put in cash if you have the cash, but now you're putting your cash in to try to cover your GameStop.
Oh,
loss.
absolutely. It's an ugly situation.
Yeah, ugly situation. And then what if the market closed in the meantime, but you still have a 24-hour time frame? I mean, could that happen? We had times when the whole market closed.
Sure.
There's no trading, but the 24 hours went by. So when the market started up again, your broker had already sold you out. You had no say in the matter. And I believe that the broker can sell whatever that you've got that they want to. They don't have to sell the stock that you had the loss in. They can sell whatever, they can sell your good stuff. They can sell whatever they want.
Well, I have no experience in that, so I
believe this is true. But living in Chicago and knowing some people who were either in or married to people who were in the commodities market where things get wild and woolly and
oh yeah.
are right now. It's like tomorrow. And there's very little room.
It's not tomorrow, it's now.
It's now, yeah.
And we live in the age now where you can move $1 million from your bank to your brokerage account in 3 minutes, and they don't expect you to deal with it next week, Friday. They expect you to deal with it now.
Okay, so that's another cost we have. We think it's all an advantage that things can move so quickly with money.
That's why they have the market breaks, where if the market changes too much on a particular stock, or if the market itself goes down too fast, they have the break and it just shuts the market down for 20 seconds or 2 minutes or 5 minutes or an hour, theoretically for half a day or a day, so they can close the accounts that are open at whatever is the number. Then they reopen trading again a little bit later, and it may be, it may have closed, something may have closed at 100 and it reopens at 62. And you would have liked to have sold at 99, but you don't get that chance because everybody was trying to sell at 99. And so all of a sudden the market is overloaded on sellers, which is what the book is about.
This is what the book is about. Okay. And we haven't even gotten into the next level of this, which is short selling. And we'll get to that in just a minute. But so far, what we've said so far just has to do with people investing either their own or margin money in a long position. You buy it and then you're going to sell it. And if the market goes down, then you have a loss, and it goes up, you have a gain. Now, on top of that, we have this whole other category that Galbraith is going to get into about a short sale. And the reason that the amateur investors in GameStop were trying to outwit somebody is because the hedge funds had shorted that stock. Now, I'm going to ask anybody who understands this to just briefly, I do understand it, but let me have one of you understand what that is. It basically means you sell it before you buy it. And when you do the sale before you're going to buy it. So you're buying it at what you consider a high price. This stock is overpriced. I'm going to record a sale and borrow those shares from my broker. And I'm going to wait for the market to go down. And when it goes down, then I'll buy it. That's called buy low, sell high. Only you do the buy first. It's buy low, sell high, but you sell it first. Now, if the market doesn't go down, then everything's upside down. The more it goes up, the more you lose, because you're trying to buy it on the way up. It's going up. You've already sold it, and you're trying to buy it now on the way up. So the more it goes up, the more you lose. Now, Galbraith gives, or not Galbraith. So one of the writers gave this example of the worst that can happen with a short sale. Let's say that GameStop is selling at 17, which it was at one point in January. $17 for a share of GameStop. and you buy GameStop and it goes down. It goes down to 0. What's the most that you can lose? $17, right? The most you can lose is 100% of what you put in. Now let's try a short. Now you bought it at, let's say 34, because you thought it was going to go up from there. But no, you thought it was too high at 34. So you shorted it at 34. You sold it at 34, hoping it would go down. And it goes down to 0. Then you've made $34, right? Because you buy it at 1. And when it gets down to 1, you buy it. So you bought it at 1, you sold it at 34, you made $33 because you sold it first and you bought it later. And you just barely got out before it went to 0. So you made $34 in your short sale. That's really, really good. Now, but if the market goes up and you've already sold it at 34 and it goes up to 340, you bought it at 30, now you sold it at 34. And now you're buying it, you're covering your short at 340. And that's not even the end. I mean, the losses can be infinite because it could go up from 340. We have examples of just incredible price changes in this book toward the end. If you're short, your losses can be unlimited. And then in a crazy wild market, you may not be able to buy it because, as George said, once it gets overloaded at a certain price, it'll move to the next price. And so on a short, your losses can be up to 100%. But your gains can be up to 100%, but your losses are infinite. Your potential losses are infinite. And so people having just unbelievable losses in their shorts. This is what the GameStoppers were trying to do to the hedge funds, is play gotcha with the people who had shorted, so that even though it is probably overvalued at whatever, it's going to go up some more because of the GameStoppers. And then the hedgers have to cover their shorts. So they do have big losses, just enormous losses, but they are enormous players. They are Goliath. They're huge outfits. Up to a point they can cover that. So the short selling is just another just really poison pill that many people don't understand, who get into this don't understand that the only people who make out on short sales are the fees that the brokers charge. The brokers are making it on the way up and on the way down with the transaction fees and with what they charge on margin loans. So margin loans can, the rates on margin loans can change overnight. It can change without notice. If you go into Schwab and put down either margin loans or short sale, some stuff will come up that'll describe exactly what they're telling you is going to happen with those types of sales. And then when you come and complain that you lost some money, they say, well, we told you exactly what the terms were. This is what you agreed to. So, you know, they're not obligated to bail you out. So look at the problem then that Congress has, trying to later unravel all this and figure out who they need to save and where public money has to go into to make something up to someone who had losses or something went wrong in the markets. So Galbraith has things to say about this all the way through too. I see that we have some questions in the chat room. Let's, Diana, what do you see in there?
Linda, there's just the one early comment from George. I don't have any questions right now.
Let me hear some other comments or questions from people about what we're seeing in these chapters.
Well, I would just say the one thing that surprised me or I had forgotten about was the extent of the real estate speculation in Florida. I mean, that was astonishing.
Yeah.
Yeah. Now, as you said earlier, I forget who it was, who was giving an example of borrowing money for real estate. In the 1920s, when times were good, down in South Holland, those young farmers, like my grandfather, was just building his family. He was getting started in farming. And a lot of his buddies were mortgaging their farms to buy another farm. They'd say, well, Tunis Verdine, you can grow crops on more land. You just only have to put down 10% or 20%. They'll mortgage the land, and you can carry a mortgage and have 2 farms instead of 1. Now you have double whatever you made on your crop and so forth. Mortgaging the home farm to buy another one, and then as he said, using the equity in that to buy another one. And they were doing that, and they were calling my grandfather foolish for not knowing that this is the new age. Farmland doesn't go down, it's forever, there is never enough farmland, and this is really rich land, and agriculture is a basic economy. So how could you lose in farmland? And he was conservative, and he said, no, I'll tell you what, I'm going to rent extra farms. I'm not going to buy them. I'm not taking a mortgage on my home farm. I'm going to rent the extra farms. So he was in a position to, when the crops dried up, just give up that farm. Don't pay rent anymore. Just get out of your lease, and that's it. But everybody else had no crops, and they had 3 farms that were mortgaged up that needed the payments. And so they were losing their farmland. And in 2021, there was a big drop in the value of farmland. So the farmers who made out at the end of that story were the ones who didn't buy when leveraging was the big thing and everybody was adding farms. And then after the whole crash had come up, that farmland was available for cents on the dollar. Just like in Florida, they said that farmers eventually got it back. Sometimes it had streets and street lights on it, and was half ready to sell as lots. How could they even make it a farm anymore? But they got the land back because one buyer after another down the chain had all lost what was underneath it. Now, did you catch that the name of one of those Florida land speculator was Ponzi? Have you ever heard of a Ponzi scheme? What is a Ponzi scheme?
A Ponzi scheme is an investment scheme where the returns to the first investors come from new investors. So they don't really generate any earnings or money. They use new people to pay old people.
There you go.
And that continues until you can't find any new people.
And then when you can't find any new people, then what happens?
The music stops.
It is musical chairs, yeah. If you have 20 people playing musical chairs and one chair is open, your chance is either 1 out of 20 or 1 out of 19 that you will get a chair. I guess it'd be 1 out of 20, I guess it'd be. So now 1 chair is subtracted. Next round, you get down to 14 people, and now there's 1 chair missing. Now your chance of getting a chair is 1 out of 15. Or your chance of being eliminated. Your chance of being the one who can't find a chair is 1 out of 20. Now at 15, it's 1 out of 15. And when you get down to 5 chairs, 5 people and only 4 chairs, now your chance is 1 out of 5 that you're going to be the one that doesn't have a chair at the end. And then at the end, it's only 2 people over 1 chair, and it's 50-50. So that's the idea of a Ponzi scheme, isn't it? As you start subtracting the number, then the chance that you're going to lose goes up all the way down, and the Ponzi scheme is over. What are some examples of Ponzi schemes that?
Well, wasn't Bernie Madoff running a Ponzi scheme?
I think so. Yeah, I believe that's basically what he was doing. And of course, he mentions Madoff. Let's see. Where does Madoff come into? Oh, well, Bernie Madoff is mentioned in the introduction in 2008, rediscussing the collapse of 2008, because so many people lost in the fallout from the Bernie Madoff thing. How many of you knew someone who lost money in the Madoff thing? Well, it was anybody who had investments in certain things that made off. There were a lot of people whose pension funds were affected by the Madoff scheme. Okay. What else intrigued you about the way this works? Now, in our opinion, as citizens who should have freedom of the market, Diana probably had a question, but in our opinion, as we believe that markets should be free, there shouldn't be government controls on the markets that prevent people from taking risks, right? From taking really as much risk as they want to. Because, I don't know, because you have a right to be wrong. Otherwise, how can you really have a market? There's nothing even really conceptually wrong or morally wrong with margin lending. That's really a technique by which brokers can let you somewhat increase your access to the market in a safe way. So maybe there's nothing wrong with it.
I got trapped a little during the boom of money for properties and that, because I kept getting offers from my loan place. Oh, here, we can give you another so many years and that. And I got to the point in my job where I became dispensable. And at 63, to continue in what I was in the health profession as a nurse, and to go into another area in nursing where I'm starting from scratch, I thought, oh, Lord Almighty, I can't do it. I'm not resourceful enough, because, you know, I'd put so many years into what I'd done. I just felt like I was scrabbling. And I owned my house, quote, in quotes, because the loan agency owned it too. And my options I lived in Indiana, and I was by myself. My kids were elsewhere. I was divorced. And so I said, what can I do? You know, I've got this house with this great mortgage, and to go find a new job at 63 is not an easy thing, especially in these days, and in those days either. And my sister helped me, and I gave my property up with deed in lieu of foreclosure. And so all my investments I had put in it were gone. I had nothing to show for it, but I did get out of it with that deed in lieu of foreclosure, which takes 8 years to get out of being under the onus of that debt, basically.
Yep. So it's costly to say goodbye, but sometimes it is a judgment, isn't it? Between, probably you and your sister had discussions about it. At one point, it is the wisest thing to get out. And
yes.
Yeah.
And the rest of my family had not much to say. My children are that, but fortunately, my sister lived here in Holland, and I loved Holland. And she said, "Well, you know what Holland is. Let's bring you up there." And that's how I got here. And thank God I did, because that's the best investment I ever made.
Yep. Well, I love Holland also. Holland has a very interesting and rich real estate market, and has over the last 15 years. It's very interesting what has happened in Holland. I think we'll get to some discussion of how various depressions and crashes and changes in the market have affected Holland, Michigan, kind of later on when we get to Galbraith's last chapters. That'll be an interesting application of how we see this. Diana was saying that, you know, our attitudes toward risk are, I think, formed when we're quite little. I really think that the stories we hear and things that we read teach us something about risk taking. And how many of you think that willingness to take risk is to some extent part of your personality or your character? Like, Some kids are the kids who will jump off the top of the monkey bars and never look at what they're doing. Other kids don't take those kinds of risks. You know, they're just, even when they're 4 or 5, you don't see them do foolish things that are very dangerous. And other kids are just risk takers from the get-go. And it isn't just boys and girls. It is a little different than that, don't you think? But many times we learn from stories the price of taking risk. I was thinking this morning about the investment-related lessons we learn from children's nursery tales. Little Red Hen. The little red hen does all the work. And after she gets done doing everything needed, then everybody else wants a piece of the action, right? They all want in when you had a success, but they didn't want to help build it in the beginning. So that relates to investment in a way. The 3 little pigs. The big bad wolf comes along and he blows down the house of straw and he blows down the other frail house. But the brick house, what you want is a house of brick. So if you start with something sturdy foundation, it will withstand the tempests of time. The Pied Piper of Hamlin. All over writing about investments, people talk about the Pied Piper who led somebody off in the wrong direction, who led them to their doom, and they were gullible and followed along. Who remembers the story, The Celebrated Jumping Frog of Calaveras County? Remember that story by Mark Twain? What was the idea there? One little kid loaded his frog with shot, took buckshot and stuffed the frog with buckshot. So the frog couldn't jump. He obviously couldn't win the jumping contest. So he knew which frog was going to win the contest because he loaded, because he cheated. It was the trickster story where one of the frogs was completely disabled. How about Peter Rabbit? Well, Peter Rabbit has adventures while his good little sisters, Flopsy, Mopsy, and Cottontail, stay home and do everything they are told. And they get to have their supper. But Peter Rabbit has to go to bed without any supper. But the point is that Peter Rabbit had the adventure, and the story is about Peter Rabbit, not Flopsy, Mopsy, and Cottontail. So sort of the kind of sly moral of Peter Rabbit is it pays to have adventures. How many of you think of the American people as venturesome by nature, and that is a good thing? John does, and John Buttry does, and Brad and Diana. Venturesome. Let's try it. Let's see what we can do. And that the stock market and its ability to raise capital serves that characteristic of our people. And venturesome compared to what? How many of you also think that the fact that we have accounting systems that in general are standard and that we can rely on? I mean, at least we have laws and rules that if we look at a company's statement, yes, there can be lies embedded in this and shaving the truth, but there is an understood, enough methodology understood that it's possible to do rational comparison of different countries, companies, and opportunities. And if we didn't have this underlying thing, if everything was completely rigged from the get-go, and nothing you read can be relied on, like in some country, some other country, Russia, China, or a not very developed country that doesn't have the system that we have, that underlies the stock market. I mean, after all, the stock participation in the stock market is international. And they flock to the American stock market for a reason, not just because America is so rich, but because the stock market itself maybe is a system that that works, that isn't all completely rigged from the get-go. How many of you worry, though, about various kinds of rigging? And certainly Galbraith is talking about various kinds of complete rigging and hoodwinking people out of money that is part of the story that he tells here.
Linda, I wonder if one of the differences today versus then is, I remember one of the questions in the reading for today is, who regulates the regulators? And who's there in 1929, 1930 to challenge the assumptions that were being made? And no one took that on. And certainly the Federal Reserve was not taking that on. They were remaining silent. I think one of the changes that we'd like to believe, although there's still, things happen today where there's no one who's really truly challenging assumptions in a lot of different areas of our society. But I'd like to think we have now in place some of the safeguards, those that are put in place specifically to challenge those assumptions and to regulate the regulators.
Okay, good point. And to what extent do you think a free press helps the stock market stay legitimate?
To whatever extent we listen to more than one channel.
Yeah. It's all in who you're going to put your trust in. And if there's ever a subject that is a troubled subject today, it's who are people listening to and what do they believe? Who do people believe? Like studies show that 45% of adults in America believe in ghosts. So, but it seems to me that from the time kids read fairy tales about tricksters and hear stories about obstacles overcome, a child who's exposed to things like that is going to develop critical thinking that enables them to be the skeptic that we need to be in order to sift out the truth. And anything that pulls children or people into one little bubble system where somebody can't be wrong, or they're looking to one figure they idolize, that kind of thing, and lose their ability to ask questions. That's the sort of mentality that is dangerous to the stock market and also dangerous to the person.
I would like to recommend a book that I just read because it was, the name of the book is Bad Blood. And it was about the article rise of a company called Theranos, which many of you may remember had publicized the fact that with a pin, just a prick of your blood, it could do all kinds of tests. And it turned out to be a complete fraud perpetrated on any number of investors by this young woman named Elizabeth Holmes. The book is written by the Wall Street Journal investigative reporter that broke the story. But it's a fascination because she was able to recruit people to her board, like George Shultz, the former Secretary of State, and all of these people of great wealth. I mean, we're talking great wealth in Silicon Valley. And it was a fraud. I mean, it was a total fraud. But I think that goes back to being you have to be a skeptic if you want to be in the market.
Yeah. But sometimes it's hard to be a skeptic. And one of the things that one of the sayings of Warren Buffett from one of his letters is, nobody was ever criticized for losing money in IBM. In other words, if you're doing what everybody else is doing, if you're just following the trends and you're following the favorite hot tip of the moment, well, nobody's going to criticize you for losing money in that. Whereas if you lose money in something that was your own idea derived from independent thinking, well, you were just a kook and you paid your price. How how many of you are concerned about the level of pushing gambling that we're seeing today? And the view that the stock market is just a gambling market. It's just another market in which you just take a flyer and put your money down somewhere and hope it goes up. Rather than something that does have, yeah. The young fellow who helped me set up this morning was talking about, we were talking about how sports gambling, or like Super Bowl betting, is off this year because the games are, the office pools aren't taking place because nobody's going to work these days. So it's this gambling urge that's finding its way into the marketplace. And I don't like to see the culture go toward, well, we should only have the elite blue bloods of the investment world be doing the investing because they know what they're doing. And we don't want the riffraff coming into this market because they'll just mess everything up. I don't agree with that. I mean, the whole idea of the intelligent investor and of the stock market itself is that anybody can invest who meets the same criteria to get in. And anybody can start reading and start thinking and analyzing and put together something that makes sense. How many of you know?
It comes back to regulation, because we get caught up in the psychology of, for lack of a better phrase, mob rule, financial mob rule.
Yeah.
And you see the most intelligent people in finance sometimes get caught up. So if we don't have anything that'll make us individually take pause, we can get caught up. And that concerns me, because I've seen examples within my own family where for years there was good financial stability, doing the right things. And then all of a sudden there's something that makes it click and you follow the mob rule and then you get burned.
Yeah. Yeah. Especially as we get older and the number of years that we have left to make it back are, to make a big mistake. And
Exactly.
And, actually, the crash of 2008, some of the journalism at that time pointed out that anyone who was just about retirement age at that time, and when the pensions had dropped by a third, and now this age group had to start drawing on their pensions, they were going to pay a huge long-term price, because they were starting to draw out at the time that you still need to put in to make up for the fact that the pensions were down. And I knew many people who did extend their working years beyond, I turned 66 in 2008. So anybody my age was just at that Social Security age where you can start taking your Social Security. And you might think that retirement is the most natural thing, but you would hesitate because that pension was down so much that you thought, no, got to work a few more years, got to shore this out, and extending retirements.
Well, it was also a period where there was these pensions were self-invested in their own company. And so went your pension as the company did, for better or worse. And there are people who lost their entire retirements because they were in the pension of that company and therefore had to postpone retirement or lost work and their retirement all in one fell swoop. Now you see some limitations that are put on the investment of pension funds to protect the employee.
Yeah. Good point.
Well, the other thing that's worrisome is the disappearance of defined pension plans. So, for many years, that was kind of more or less safe and set aside. It was replaced by 401ks, which were largely self-directed and subject to the whims of the market and subject to the knowledge or lack of knowledge of the investor.
Good point. Now, Brad just made a distinction between a pension and a 401k, and that pointed out that when I said the word pension, I really didn't mean that. A pension in the classic meaning means you have a fixed pension that's guaranteed for your lifetime by the company, regardless from the point that you qualify for it, right? That is what you are entitled to. And that was the old style pension of many years ago. Then maybe in the 80s or so, it became most companies gave up the fixed pension that was guaranteed and put their employees into the 401k instead, or 403b if you worked for a nonprofit company. And then, as you said, the self-directed IRA pension, the self-directed 401k, where now would you still only have choices of mutual funds versus, or could you do your own stocks in that? Oh, you're muted, Brad.
That depends on the plan. In
Okay.
some cases, you have more latitude than others.
Okay. All right.
I've got a comment about I didn't know anything about my parents, whether they were or not in stock market, but my wife's dad, he was a pharmacist, and he invested not in mutual funds, but individual stocks tended to be pharmaceutical. And he made more money after retirement in the stock market than he did as a pharmacist before that. And if the stock market went down, my wife might say, "Hey, Dad, your market went down today." Well, I can still eat.
I can still eat. Yeah.
He made a lot of money, and it was a game. He loved to. I mean, he would call his stockbroker, once or twice a week, and how's the market today?
Uh-huh.
My
Well, go ahead.
was not as wise an investor. He owned a huge cattle and wheat ranch in Washington State, and any number of Klondike would-be's were on the road through the area where his ranch was. And when I visited with my parents after World War II to the uncle that had inherited the ranch, they had wallpapered the whole stairwell to the second floor with gold stock that was no longer.
A reminder that all things pass away.
Oh, you know what? That is just an excellent, excellent story to end on today. And we'll have more stories next week, and we'll read more chapters. And I would like you all to join me in thanking Linda for a stimulating hour and a half. I think it works really well when you just unmute yourself and join in. We don't have any then awkward pause of recognition. So we'll continue to do that for the next 2-3 weeks. And I just want to say that I will unfortunately or fortunately not be here next week because I'm going to get my second COVID shot.
Yes.
So I have to drive an hour to Plainwell High School, wherever that is. But I'll be back the week after. So be kind to Linda and take care of her and continue to bring in your own comments and stories. Thanks so much. Bye-bye.
We'll be here next year.
Bye.
Thank you.
Because I'm getting my second COVID stock.
All right.
next
Well,
year.
just a second, why don't we put up either 1 or 2? If you've had 1 or 2 shots, let's just see a picture for Diana. She can see all those pictures. Have you had a shot and have you had 1 or 2? You're getting there.
We have one.
Okay. And I'm getting 2 next week. Oh,
I'm getting 2 on Valentine's Day.
me too, same day. That's right.
Our second one is Monday morning, 5 a.m.
It's wonderful.
Whoa.
It's wonderful. You're very,
Take it when you can get it.
you're really very willing to get up at that hour, aren't you?
Where have you gotten them through? Where have different people been successful?
Spectrum Health.
Metro Health.
I live on way the south side, and mine have been through Allegan County.
I'm in a I'm over at Freedom Village and they're doing all of us.
Oh, wonderful.
Suzanne just pointed out Evergreen Commons is distributing as well.
Yeah, I'm getting mine.
I think that's just members though, right?
It is.
Correct.
Yes,
Only
Yes.
members.
It's a good way to get members, I
Right.
guess.
I'm tempted.
Well,
It's a great place to begin with, so.
Ottawa County is taking care of a lot of people as well.
Yeah, that's where well, one of the places I signed up.
I registered with both Ottawa County and Spectrum Health, and Ottawa County didn't come through, but then Spectrum Health came through on a one-day notice. I could get an appointment the very next day.
Wow.
That took me all the way over to a facility near the airport in Grand Rapids. And I
Wow.
thought, fine, I'll drive over there. And this facility was absolutely amazing how big it is and what capacity they could do. They're doing 2,000 shots a day right now. And I think that they have the capacity to go double that. They
Wow.
just
Okay.
going to be gigantic. And it was very well organized. The
I,
appointment
yeah.
was only a little bit late and everybody was masked and orderly and everything was great. The National Guard was there, you know, supervising everything. It was quite impressive.
I've heard that same thing from many different people in many different locations, that it's been very well organized.
Yeah, and capacity to increase, like they've really gone big scale. So that's very assuring too, because now they just have to get the people out there. But we also need neighborhood clinics and everything. We need
We
some,
sure do.
we need it everywhere that we can.
Yeah.
I'm very hopeful that Michigan is going to be able to do a good job overall. Anyway, thank you, everybody. It was an interesting morning.
Thank
Thanks
you.
for all the good questions and comments.
Thank you, Linda. Linda, are you comfortable with just unplugging your computer and letting yourself out of the office?
Yes, I can do that. I can
Okay.
get out of this and.
There are some light switches by the door as you leave the classroom. I think they'll go off automatically, but if you could just to be sure,
Okay.
hit the off button.
Wait a minute, now I'm not.
I'll
finding-
stay on with you until I
Okay,
don't see you
Good,
anymore.
because I'm not finding my cursor right now. Where is my cursor?
Do you have a touchpad on your computer?
Yeah.
Try.
Oh, yeah, escape. Maybe. No.
You should. Are you?
Oh, yeah,
plugged in?
I see it. I
Okay.
see.
Oh, your cursor, because you're on double screens, your cursor might be being shown on the projection
My
screen.
cursor is on my laptop.
I think if you unplug directly from the Ethernet cable, unfortunately, we'll lose you when you do that. So make sure we're,
Just pull out the plug and everything's fine, right?
yeah, and then we'll be gone. So have a safe trip back to your house. Thank you so much.
All right.
Thanks, Diana Nelson.
And I
you're
just.
welcome.
Susan,
Bye-bye.
everything's fine. I just go out the door and everything's fine.
Everything is fine. Go out the door, be safe, and good luck on your next shot.
See
Bye.
you.
John McDonald, did you get in okay today? You're muted, sorry. Mute is in lower left-hand corner of your screen. Oh, click it one more time. Yeah, I saw you in the waiting room and it looked like it was having a hard time connecting. So
Yeah, well,
saw you in
I'm kind of a computer illiterate, so it's all right. But
you
I'm
did
learning.
great. No, you got there. Sometimes it's not the user's fault. So give yourself some credit that you're here.
Okay.
But I saw your name come up and then I saw like an hourglass spinning. And so I thought, you know what, sometimes it's just technology. Don't worry about it. So welcome.
Yeah, and no, I've learned at my stage of the game, you can't criticize me.
I wouldn't even.
And I know you wouldn't. I mean,
I wouldn't. And at my stage of the game, believe me, every single day I go,
I
there's,
know.
yeah.
But it's a learning process, and I understand that totally. And I'm 86 years old. Not that that's an excuse, but I think I can handle any kind of comments or criticisms or whatever.
that you will get none. And I say this to my mom too, because she is just a super smart, very well educated. And she's like, oh, I just can't even do this. And she gets flustered. And I've told this story before, but I'm like, Mom, I can't play a concerto on the piano because I don't practice. It's not what I go do every day. Yet she is a concert level pianist and has a hard time checking her email. But if she's, it's just,
Yeah, it's okay.
you're here, my gosh.
We all have different skills. I have no problem.
Exactly. And it's also the ones that we get to develop and have the time and the necessity. Before COVID, did you ever have the necessity to use Zoom?
Before COVID?
Yeah.
No, I never did.
Of course. Guess what? Before COVID, I never used Zoom. And I've been in business. I mean, I didn't grow up with computers, but from about 25 on.
Right.
So anyway, enjoy the rest of your snowy day.
I will. And your programs are terrific, I think.
Oh my gosh. Linda's wonderful speaker. She's great. She would have been a really wonderful professor to be taught by.
Yeah. It's been a long time since I've been in an academic setting, but
I know, me too. And here we are.
And here I am.
And my only regret is sometimes, so I host the class. I haven't met you in person, but I'm the program coordinator. And so I open up the classroom, but a lot of times during the presentation, I have to do other work. And I'm sad because I kind of want to just be watching the class.
Well, not to talk about personally, but I moved here about 3 or 4 years ago, okay? And Audrey Blumenthal recommended me and so forth. She was the only one I knew in Holland, So anyway, she recommended me. HASP has been a godsend, to me. I learned a lot of stuff. I forgot a lot of stuff, but
I know, right? When's the last time? It's been for me. I graduated from college in 1993, and I've taken some business courses, but our acuity to like listening and kind of understanding material, we lose it after a while. And so I think it's interesting, and I've realized that my attention span's a lot shorter now, or maybe it wasn't very long back then. I don't know, but you have to retrain yourself. But it's interesting. And I'm glad HASP has been good for you, and hopefully we'll get back.
It's been great. It's filled a lot of the empty hours, if you will. Although I've adjusted pretty well. And I went to college at, one degree in the 56, and that's 1956, not
okay.
And the other one in 60. Okay. So
May
it's
I
been
ask
a long
what your
time since
degrees
I've
are
been in
in?
an academic situation, but I'm enjoying it immensely. I think it's terrific.
That's awesome. What were your degrees in?
Well, I got a degree in political science at Michigan, and a Juris Doctor from the law school at Wayne.
Awesome.
So, but I'd be the first to admit I don't know everything.
Then you're a step ahead of most of us.
I don't know about
great
that.
humility to have, but and you've been in retirement for how long?
Well, I practiced law 24 years, and I was a judge for 24 years.
Oh my gosh.
So I finished that in 2008, okay? So, and then I worked part-time. I traveling judge, so to speak, for about another 7 or 8 years, so.
Unreal. So that, if I do the math, you said 2008 plus 12 plus 7, you didn't really retire.
No, I didn't.
Very long ago.
No.
That's awesome.
Yeah, well, I don't know about that, but it was good for me, something to do, keep my brain halfway working and so forth. So, but I've enjoyed it. I really have.
Good. Well, it's nice to talk to you today. Where are you living? Are you on the south side?
I live in Macatawa Legends at the Macatawa Golf Course. I bought a small place, and that's really a nice development. I'm very satisfied with that.
It's beautiful over there.
And they built it. There's hardly any spots left now. I think they're all sold out.
Yeah, and understandably, it's beautiful, and the way that they developed it is wonderful, and you're very close to everything you need right there.
Yeah,
with
and the main
groceries.
reason I moved here, not to bore you with that, one of my sons, our sons, lives in West Olive,
Oh, yeah.
and the other two live in San Diego. So my choice was Holland area or San Diego, which I love. The weather, you can't.
I
beat
was
the-
gonna say, not to bore you, but I moved back from Michigan 12 years ago, from San Diego.
Oh,
So
did you?
I lived there for a lot of years,
Okay.
Los Angeles and San Diego. Where are your son?
They both live in San Diego. Ironically, my son and a daughter.
Okay.
And she went out there because she graduated from Michigan. She had a degree in bilingual. She was a fluent Spanish teacher.
Uh-huh.
Spent the last year of her college in Spain, in Sevilla. But she went out there and to teach, and did teach for a couple of years, but then she got pregnant and had a child and so forth and so on. So anyway.
Cool. That's so cool. My stepdaughter was just in Sevilla when COVID hit, and we had to pull her home because for obvious reasons. But
Sure.
but anyway, it was a pleasure talking to you today. Glad you got in the class, and we'll see you again soon.
Yeah, okay. Someday we'll meet in person. Okay.
Yes, we will. I'm Susan. I know it doesn't say that on the screen, but it was nice meeting you virtually.
Sure. Well, that's my daughter's name, Susan. So I should remember.
Easy to
that.
remember.
Not
That's very-
Suzanne. Is yours
Not
Suzanne?
Suzanne and not Sue.
And not Sue.
Not Sue.
That's a Johnny Cash song.
That is a boy named Sue.
That's right.
Um,
Okay.
Have a great day. Take
Yeah,
care.
you too. Thanks very much. Good to
Yeah,
talk to you.
bye-bye.